Welcome back. As we enter this second hour, the Dow Jones Industrial Average is currently up 52 points to 12,960. The NASDAQ is up 19 points to 2989, and the S&P is up 8 points at 0.6% to 1373. The dollar is having a rare up day as well, as are most of the commodities. But right now we want to talk about the precious metals, primarily silver. Jason, would you please introduce David Morgan to the listeners?
Absolutely. We're joined once again on the phone by David Morgan. He's the publisher of the Morgan Report, a leading U.S. expert on the precious metals and precious metals investing. David, we've had some pretty significant moves in the metal since we last spoke.
Boy, have we ever, Jason. We talked about a breakout, which took place on good volume, and it wasn't but a few days after that, and there was a huge sell-off in silver and gold, particularly in silver. And in fact, it was, I don't know if it's a record or not, but I know the facts. And what was done was the shorting of the market, naked shorting. There wasn't nearly this amount of silver available. Of 110,000 contracts, and people that know the commodities well know that the contract in silver is 5,000 ounces. So if you multiply the 5,000-ounce contract times 110,000 contracts, you have 550 million ounces of silver were sold short, were traded that day. And during the trade, most of it was selling pressure, not buying pressure. And silver ended up down about 250 for the day. So certainly it was quite an event. Intraday, it was off almost as much as $4. And so this, of course, took a lot of steam out of the bull market, and I do think it will take a few weeks to repair the damage, but I'm still long-term bullish. It hasn't changed that, in my view, whatsoever.
David, I had read sort of an after-action report on that, and they were saying that they were trying to take the silver market down, and actually the fact that they were not successful despite that massive short selling was indicative of a much more robust longer-term bull.
Well, I agree. I've read quite a bit as well, and the way I like to put it is in the context of the real versus the paper market. And in the real market, Eric Sprott, who started from Sprott Asset Management, he's a well-recognized, one of the best and richest hedge fund managers in all of Canada. He's very bullish on the silver market. He started the PSLV, which is the Physical Silver Trust, where you can actually take metal out of the trust if you wish to do so. And he bought about 10 million ounces of physical silver recently, and the price was right around the $30 mark, and it moved it up to around 32.5, 33. And here again, intraday, the price spread was almost $4 on silver, but it settled down to $2.50. So what that tells me in very simple arithmetic is it took 55 times more selling pressure on the paper market to move it down to $2.50, and it only took 1/55th as much in the real market to move it up equally. So that tells me that the physical market has a much, much greater impact on the silver market than does the paper market. Obviously, there's no rule in place there's a rule in place, really, to take care of this massive kind of shorting, but it seems that the authorities ignore it. It seems as if the only market manipulation that can take place in silver is from the long side. They never seem to be able to get their minds around the fact it can be done on the short side as well. But that's my opinion. I mean, there's still an ongoing investigation into the price mechanisms and mechanics of the silver market, and they've really yet to produce their final finding over this last few years' investigation. So perhaps I'll be surprised they might come out with something. But regardless, the physical market is far, far more important than the paper market, and as I just explained, much more powerful.
David, just for the benefit of our listeners, would you please explain to them the difference between the paper market in silver and the actual physical market in silver?
You bet. The silver market physically is what it says, obviously. If you're going to be manufacturing something that requires silver, like a major motor company, any auto manufacturer, Dow Chemical, for example, DuPont, any major electronics manufacturer like Sony or Panasonic or any of the Japanese manufacturers. Of course, there's Koreans and others now heavily into that market, all require a great deal of silver. And that's the physical market, and they actually go in and buy physical metal. Now, what people don't understand is that most of that metal comes direct from the smelter. They don't ever go into the paper market or the futures market to buy their silver. There's kind of a misunderstanding on a lot of people that, all the silver flows through the COMEX, and this simply isn't true. In fact, the COMEX is more or less like a display, as an analogy, a display of a clothing store. You might have a one woman's dress on a mannequin and one men's suit in a mannequin, and that shows you, what you could buy. And behind it is a store with, racks and racks of clothes. Well, racks and racks of clothes are the smelters, and they're the ones that are distributing the silver to all these users. But if you wanted to, you could come into the store and buy the one, in the display. But all the rest of the stuff is basically from the wholesale market. Having said that, there's a lot of hedging, quote-unquote hedging, that goes on, and this is done through various paper markets, primarily the CME, the COMEX, and this is unrestricted as far as how much paper or fictional, non-existent silver, or naked shorting as it's called, that can be accomplished. And so in any given day, at any given time, a major entity such as a bullion bank or a large entity such as that could come in and start selling silver that really doesn't exist in their warehouse, doesn't exist in their vault. They don't even have access to it. They don't even have a contract with the smelter of that massive amount. They might have a contract with the smelter, but not in those kind of quantities. And so that paper selling forces the market down. I've said many times, and it continues to be true, that for a very long time the market doesn't care if the selling is real or fictional. It will take the price wherever the price is going to go. But again, what it's showing me is that amount of selling taking place, say 3 or 4 years ago, probably would have taken the market down several dollars. And now it takes it down 2.5. And the reason being is that, one, a lot of people that are savvy to what's going on see that takedown as an opportunity to buy. That's one thing. And the other thing is they're running out of ammunition. I mean, the floor traders even are starting to wake up and understand it. Even, good traders that maybe saw the open and saw it was down $1 and got out, reposition themselves at the low of the day. So, very interesting. People ask, well, what will happen next? And, really, I don't know. I don't think anyone really knows.
David, there's always been this rumor out there that one of what we call the banksters is sitting on a extra large naked short position in silver. Do you buy into that? Pretty
much. I don't think from the public domain that you can determine exactly whom it is, but this bank participation report gives you a pretty clear idea. And then a gentleman named Jason Hommel went in and looked at the BIS, the Bank of International Settlements, position on derivatives. And what he did, I think, was common sense, and it took a little bit of thinking. He took all the derivatives exposure and he subtracted out the different types of derivatives that were there, and then what remained would probably be in the silver market. And it was a massive amount. I would give the benefit of the doubt that, we don't know exactly, but it's a pretty good indication that the position that is held by J.P. Morgan on silver is pretty much acknowledged throughout the silver community to be massively huge relative to what they could physically hold.
And that is it's a naked short position.
That's correct. Unless they have some hidden cash somewhere, which I really, really doubt, and I'm just saying that just almost as in a humorous way. If you look at the public domain, the amount of silver that they hold is pitifully small compared to a lot of the other approved banks, such as Scotia Makata or what's held in Brinks or even what's at the Delaware Depository. Those entities have far more physical silver than what's held by J.P. Morgan, and yet J.P. Morgan has the largest short position from what we can determine of all of them.
And didn't they acquire some of that? Was it Bear Stearns that J.P. Morgan acquired? I'm trying to remember exactly who they acquired, but I think that part of that was one of the Fed's maneuvers behind the scenes was to help prop up the silver. Their naked short position in silver, so we've got Federal Reserve manipulation going on in the metals market as well.
Right, that's generally accepted. I've never read documentation that absolutely convinced me, but it's pretty well established in the silver community that when Bear Stearns went down, that J.P. Morgan inherited the silver short position.
All right, and then that brings me to the other group that you hear about from time to time, the Raptors. Now, is there really a group out there commonly referred to as the Raptors?
Well, it is commonly referred to. This is based on the work of Ted Butler. Ted has probably done more in the area of looking at the Commitment of Traders report and certainly championed the situation with the CFTC to look into the manipulation of the silver price. And I think credit where credit is due. He refers to the Raptors as kind of a small, more agile group that is on the side of trading funds, which is smaller than these bullion banks that we've been referring to, that can move in and out of the market. But they have limited funds, whereas these bullion banks basically have unlimited funds. So I like to give the analogy of a poker game. If you're sitting across the table from somebody that's got $10 million worth of chips, and you start off with $100,000 worth of chips, when you get a good hand, you might really be able to load up and take advantage of it and win, a pretty big pot. But in the long term, the bank or your opponent has so much more playing and staying power than you do. Chances are over the long term, they're going to win several more hands than you. It might be a bad analogy from the aspect that it gives the impression that they can't lose. They can only win that game in terms of paper. They can't, again, as we started your show with, in terms of physical, it's actually the reverse. The physical silver is held tightly by the public and large fund managers and that type of thing, and the amount of physical silver is very small, but there's this big paper bluff,
Well, I believe we've lost David. This is Alan Butler. Jason and I will be back on the other side of the break with Bartlett Cleland. We were just speaking with David Morgan. You can get to David at silver-investor.com. We'll see you in a couple minutes.
I don't know how this whole business started. Of you thinking that